market technician, meaning I use charts and mathematics, but I also look at the underlying fundamental events that are moving the market, and that's called a hybrid technician. And right now, there are a couple of things that are definitely affecting gold pricing. First and foremost is the inflationary rate, with the CPI coming in just recently at 6.2%. Now, that's a level we haven't seen in 31 years, since November of 1960. And it's easy for most Americans, and actually globally, although there's different levels of inflation around the world, when they go to a gas pump or they buy food, they can see that those prices have skyrocketed. In fact, one of the big news stories out here is that the cost of a Thanksgiving dinner will be the most expensive one ever. So inflationary rates, because traditionally gold has remained one of the best, if not the best, ways to preserve wealth, in terms of the fact that if you get an inflated currency, gold will kind of keep up with that, and you'll have a net par gain or not, meaning that gold will go up as inflationary pressures go up to kind of match that. And I used to tell a story during lectures about that, and I'll try to do it very, very quickly. But if you had a $20 gold piece and a $20 bill back in the 1800s, you could have a weekend in the plaza, buy a new suit, have a steak dinner for that $20 gold piece or the $20 currency bill. Now, take it to the modern day. If you wanted to go to the plaza in New York and stay there for a weekend to have a steak dinner and buy a new suit, you could take that $20 gold coin, no numismatic value attached to it. It's worth, $1,800 plus. You could buy a suit. You could get a room at the hotel, and you could buy a steak dinner. The $20 bill would basically buy you a cup of coffee. Over time, gold has maintained the ability to keep up with inflation. So that's one of the first primary things that you want to acknowledge and watch very closely. Secondly, because we pair gold against the dollar strength or weakness has 100% negative correlation with gold. If the dollar gets higher, gold has to go lower to that extent. And then the differential is whether there's buyers or sellers in the market. Those are the two key elements that you want to look at. If you go a little bit further, you want to talk about national debt, whether we're running a deficit, whether our debt is growing, whether we're printing more dollars, because that has an effect on it. And then lastly is GDP and economic growth, because the idea behind flooding an economy with cheap dollars is that it puts the GDP on steroids, so to speak. And we saw that in the second quarter of this year with a GDP over 6%. Yeah. That's very strong. Typically, we get one at 2 to 3% overall GDP for a year. Because of Delta, we had a 2% GDP in the third quarter. And so that was very, very alarming. That, I think, is somewhat transitory, because the world is moving out of the pandemic stage, hopefully, and it's beginning to normalize. And no one's really sure what that new normal will be. But the most important thing that I look at is we've done a lot of fiscal stimulus. The Treasury has worked with the public in terms of sending out checks. And most importantly, the administration has been providing huge amounts of liquidity in terms of fiscal stimulus. 2020 was $4 trillion plus. This year in the trillions again. And so my concern is, at the end of the day, when all is said and done and we are at some sort of a new normal, what effect will this massive amount of spending and the increase of the national debt and the increase of the Federal Reserve balance sheet, which I believe is in the neighborhood of $8.6 trillion, what effect that will have on the overall faith in the US dollar, and most importantly, the dollar value itself. So those are really the...
Okay. The most important factors. Okay, so let's take a pause there. Let's recap what you just said because you brought up a lot of important points, and we'll revisit each of these. So inflation, first and foremost, you mentioned that this Thanksgiving could be the most expensive one. I wonder if anyone's done like a turkey to gold index. That would be kind of fun. But the higher the turkey price, the higher the gold price. But more importantly, your underlying message is that gold has preserved value over time, and you brought up the example of the $20 bill versus the gold coin. Now, that is an excellent observation, but I like to just posit a counter argument for you to address. It is true that gold has preserved value over the last 100 years, per your example, but if you look at other assets, real estate, stocks, the S&P 500 over time has also grown tremendously versus the dollar. So if you were to take, let's say 4 units or 10 units of the broad market back in the 50s and sell those 10 units today, you would still be able to afford a lot more than you could have back in the 50s. The point is, why are we picking specifically gold